Welcome to Greatest Traders by The Complete Trader's Edge. I'm your host, and this series tells the stories of history's most extraordinary traders. Not just what they did, but how they thought, how they managed risk, and what their psychology reveals about the craft of trading. Every episode connects to the three pillars: mind, method, and money. Today, Episode 6. Nicolas Darvas, the dancer who beat Wall Street with a telegram and a newspaper. It is 1958. A hotel room in Calcutta, India. A man in a tailored suit sits at a small writing desk. He has just finished performing before an audience of 2,000 people. Tomorrow, he will fly to Karachi. The day after, to Tokyo. He is one of the highest-paid ballroom dancers in the world. But he is not thinking about dance. He unfolds a copy of Barron's Financial Weekly, which has been forwarded to him by airmail. It is 4 days old. He studies the stock tables. He takes out a small notebook and writes down a series of numbers, highs and lows, volumes. He compares them to the numbers from last week. Then he walks down to the hotel's telegraph office and sends a message to his broker in New York. 8 words. Buy 2,000 shares of Lorillard at 47. By the time his broker receives the telegram, places the order, and confirms the execution, another day will have passed. Nicolas Darvas is trading the New York Stock Exchange from the other side of the world, with a 4-day delay on his data, using a method he invented himself, with no formal training in finance. And he is making a fortune. This is not how Wall Street is supposed to work, and that is precisely the point. Nicolas Darvas was born in 1920 in Budapest, Hungary, the same city, remarkably, that produced George Soros a decade later. He trained as an economist at the University of Budapest, but his career took a different direction entirely. After World War II, he and his half-sister Julia formed a ballroom dance partnership that would become one of the most successful in the world. They performed in nightclubs, hotels, and theaters across Europe, Asia, the Americas, and Africa. By the mid-1950s, Darvas was earning more than any other act in the entertainment world, except for a handful of Hollywood stars. His introduction to the stock market came by accident. In 1952, a nightclub in Toronto offered to pay him for a performance not in cash, but in shares of a mining company called Lund. Darvas accepted reluctantly. Within 2 months, the shares had tripled in value. He sold them for a profit of approximately $8,000. It was more money than many people earned in a year, and it planted a seed that would grow into an obsession. Darvas began studying the stock market with the same intensity he applied to mastering dance choreography. He read every book he could find. He subscribed to financial newspapers and advisory services. He tried every approach: fundamental analysis, technical analysis, tips from brokers, recommendations from newsletters. He lost money on almost all of them. The losses were educational. Each failure taught him something specific about what did not work. Fundamental analysis required information that was always outdated by the time it reached him. Broker recommendations were biased by commissions. Newsletter tips were wrong more often than they were right. And the more people he listened to, the worse his results became. The turning point came when Darvas noticed something in his own trading records. The stocks that had made him money shared a common characteristic. They had all been making new highs when he bought them. They had all been trading within a defined price range, what Darvas began to call a box, before breaking out to a new range, and they had all been accompanied by unusually high trading volume at the moment of the breakout. This observation became the foundation of the Darvas box theory. The method was extraordinarily simple. A stock establishes a trading range, a box, defined by a ceiling price that it touches but cannot break, and a floor price that it holds above. When the stock breaks above the ceiling of the box on increased volume, it has entered a new, higher box. That breakout is the buy signal. The stop loss is placed just below the floor of the previous box. If the stock continues to rise, it will form successive higher boxes, and the stop loss moves up to the floor of each new box. The position is held until the stock breaks down through the floor of its current box, at which point it is sold automatically. That is the entire system. It fits on a napkin. There are no indicators, no oscillators, no moving averages, no fundamental analysis. Just boxes, breakouts, volume, and a stop loss. What made this system revolutionary was not its complexity, it was its simplicity. And what made Darvas successful was not the system alone. It was the discipline with which he followed it. He did not override the signals. He did not second-guess the breakouts. He did not hold stocks that broke through their floors because he hoped they would recover. The system told him what to do, and he did it. Every time, without exception. His position sizing was equally disciplined. He never invested more than he could afford to lose on any single position. He concentrated his capital in his highest conviction trades, typically holding only 5 to 8 stocks at any time, rather than diversifying across dozens of mediocre positions. When a stock was working, he added to the position as it formed new higher boxes. When it was not working, he cut it immediately. Between 1957 and 1959, this approach turned approximately $25,000 into $2,250,000 in 2 years. While he was performing as a dancer in cities around the world, managing his portfolio entirely by telegram. The results were so extraordinary that they attracted the attention of Time magazine, which published a feature article on Darvas in 1959. His book, How I Made $2 Million in the Stock Market, published in 1960, became a bestseller. It remains in print today, over 60 years later, and is still considered one of the most instructive trading books ever written. Not because of the system itself, which is simple enough for a teenager to understand, but because of what it reveals about the psychology of successful trading. There is an aspect of Darvas's story that is often overlooked, but is perhaps the most important element of his success: his physical distance from Wall Street. Because he was touring the world, he could not call his broker for gossip. He could not watch the ticker tape. He could not attend investment conferences or read the latest analyst reports. He received his data 4 days late by airmail, and he placed his orders by telegram with a time lag built into every decision. This isolation, which would seem to be a crippling disadvantage, was in fact his greatest edge. He was immune to the noise. He could not panic sell on a bad day, because by the time he heard about the bad day, it was already 4 days in the past. He could not act on tips, because the tips were stale before they reached him. He could not be influenced by the opinions of other traders, because he had no contact with other traders. All he had were the numbers, the highs, the lows, the volume, and the boxes. When Darvas returned to New York and began trading from a brokerage office, with access to real-time prices and the constant noise of other traders' opinions, his performance deteriorated immediately. He began to second-guess his system. He began to act on tips. He began to sell too early out of fear and hold too long out of hope. The noise that he had been protected from by geography was now destroying his discipline. He recognized what was happening, and he did something that very few traders have the courage to do. He left. He went back on tour. He returned to the hotel rooms, the telegrams, the 4-day-old newspapers. And his performance recovered immediately. This is one of the most powerful illustrations in trading history of a principle that every trader in this series has demonstrated: that the primary barrier to trading success is not information. It is noise. The more information a trader consumes, the more opinions they absorb, the more real-time data they watch, the harder it becomes to follow a simple system with discipline Darvas proved that less information, applied with more discipline, produces better results than more information applied with less discipline. Let us map his legacy to the 3 pillars. The Darvas box theory is one of the simplest and most enduring methods in trading history. It is a breakout system with defined entries, defined exits, and volume confirmation. It requires no proprietary software, no complex calculations, and no special market access. It is available to anyone with a chart and the ability to draw a rectangle. And it works because it captures a fundamental truth about markets: that stocks in strong trends move in stair-step patterns of consolidation and breakout, and that the moment of breakout, confirmed by volume, is the highest probability entry point for a trend trade. Darvas concentrated his capital in his best ideas and cut everything else. He never risked more than he could afford to lose. He added to winners and eliminated losers without hesitation. His position sizing ensured that no single trade could damage his portfolio materially, while his willingness to concentrate in winning positions meant that his best trades had the opportunity to compound significantly. This balance between risk control and profit maximization is the essence of sound money management. Darvas's story is ultimately a story about the psychology of independence. He succeeded not because he had better information than other traders. He succeeded because he had less information and more discipline. His physical distance from Wall Street protected him from the noise, the opinions, the tips, and the emotional contagion that destroys most traders' ability to follow their own system. When he lost that protection, his performance collapsed. When he restored it, his performance recovered. The lesson is clear. The ability to trade your own system, in isolation from the opinions of others, is not a luxury. It is a requirement. I never bought a stock at the low or sold at the high in my life, and I do not intend to try. That sentence captures the humility and pragmatism that defined Darvas's approach. He did not try to pick tops and bottoms. He did not try to be clever. He waited for the market to tell him what was happening, and then he responded. He caught the middle of the move, consistently, with discipline, and without ego. And it made him a millionaire several times over while he danced his way around the world. If Livermore taught us that knowing the rules is not enough, if Soros taught us that conviction must be matched with size, if Jones taught us that defense wins, if Seykota taught us that the system is never the problem, and if Dennis and the Turtles taught us that psychology determines who succeeds with the same rules, then Nicolas Darvas teaches us perhaps the most liberating lesson of all: that you do not need to be on Wall Street. You do not need real-time data. You do not need complex tools. You do not need anyone's opinion. You need a simple method, sound money management, and the discipline to follow both in silence. The edge is not in the information. It is in the independence to ignore it. Nicolas Darvas built that independence, and it made him one of the greatest traders who ever lived. You have been listening to Greatest Traders by The Complete Trader's Edge. This episode was based on Chapter 68 of the book, The Complete Trader's Edge, by Louw von Riet. Available now on Amazon in Kindle, paperback, and full-color editions. For the full article on Nicolas Darvas, trading guides, and free resources, visit CompleteTradersEdge.com. If this episode resonated with you, subscribe wherever you listen to podcasts and leave a review. It helps more traders find us. Next episode, we tell the story of the man with the greatest long-term track record in hedge fund history, Stanley Druckenmiller. See you then.